Dear students, welcome to another video class in accountancy. We have been discussing about reconstitution of partnership under various cases. So far we have seen the changes of ratio without any admission or retirement or death. Then we studied admission of a partner. We studied the accounting treatment, journal entries, everything. Now today in this video class we are going to discuss another important element of reconstitution, right? It is retirement. As you may recall, in admission what happens, a new partner is coming to the business. So the existing partners or the old partners change their ratio. Okay, they give their own share for the new partner, so the ratio will be changed and there will be different accounting treatments. Everything will be new after the admission of a partner. In retirement it is more or less just reverse. The situation is just opposite, right? Here in this case, one particular partner is leaving the business, is leaving the partnership business due to some reason, maybe personal or something else. Okay, one particular partner does not wish to continue the business. He wants to discontinue the business. He wants to close everything and leave the partnership business. This is known as retirement of partnership, right? This is also an example of reconstitution of partnership, because here also the existing partnership agreement, partnership deed comes to an end, and if they want, the existing partners, the remaining partners who are not retiring, they will start a new business. Okay, so everything is going to be changed. So in the retirement also it is more or less the same thing. Only the difference is that here the situation is just opposite. So here I have given an example of three partners A, B and C. You can see it here. They are having old ratio or existing ratio of 5, 3, 2. A gets 5 by 10, B gets 3 by 10, C gets 2 by 10. Right? Now what's happening? C, as I told you, because of some reason C is leaving the organization. C is leaving the partnership business. Okay, C is going away through mutual consent. So C's share when he goes will be taken over by A and B, right? So in this particular case it will be just opposite to admission. In admission, these old partners, they may sacrifice or they will sacrifice on behalf of or for the new partner. But here on retirement, what happens? They are going to gain the retiring partner's share, because when a partner leaves the organization, he or she will give his or her share to the remaining partners. So the remaining partners will gain, right? It's not necessary that all the remaining partners should gain. Sometimes the retiring partner share may be going to one partner or two partner, depending on situations. Okay, so whoever is getting the retiring partner share, they will gain. So they will be the gaining partners, right? So in this particular case, just like we calculated sacrifice ratio in admission, we have to calculate gaining ratio on retirement. So this is also just opposite. Okay, so when they gain, their new share will be more. So when you subtract the old ratio from the new ratio, you will be naturally getting the gaining ratio. So gaining ratio means it will be new ratio minus old ratio. In some questions it will be given directly, some questions you will have to calculate. Especially when a new ratio is given separately, you will have to calculate, right? So now in this simple case, you see C is leaving the organization. C is leaving the business. So When C leaves, to calculate the new ratio of the remaining partners, you just take out this C. Okay, you just take out C's share. What's remaining? 5 and 3. 5 is to 3 remains. So that will be the new ratio, and since there is no other information given in this example, the old ratio will become the new ratio, and this new ratio will become the gaining ratio also, because no other extra information is given in this example. So old ratio of AB is 5 is to 3, and the gaining ratio of A and B will be also 5 is to 3, right? So old ratio will be equal to gaining ratio. So as I have told you, in some situations you will have to calculate, some situations it can be calculated directly, right? Okay. Now when this retirement happens, okay, the partnership firm is reconstituted, so everything is going to be new after the retirement. So these partners, through mutual agreement, they will fix a particular date for retirement. Most probably it will be at the end of a particular accounting period, okay, for convenience. So they will fix the date, and the retiring partner will go retire on that particular date. So at that time, what are the accounting treatment we have to do in a comprehensive question? It is more or less the same as that of admission, like the assets and liabilities will have to be revalued, right? So they have to prepare revaluation account. So the rules of preparing revaluation account, the principle, everything will be same. That is, when we prepare revaluation account, and when we when we distribute the profit or loss of revaluation, we have to distribute it among all the partners, right? In the case of admission, we have seen that only the old partners will be getting, new partner will not be getting anything. Why? Because new partner was not part of the old business. But in this case, the retiring partner is part and parcel of that existing business. He was very much there. So he should be getting a share of revaluation profit or loss, whatever the case may be, right? So what happens actually when the retiring partner is going, the remaining partners have to settle all the entitlement. They have to settle all the accounts, they have to find out the entitlement of the retiring partner, and he should be given his balance, his retirement benefit. Here the retirement benefit is the total balance which is there in his capital account at the time of retirement. So for this we have to consider so many items. If we see this is entitlements one by one, you can see here I have drawn up the partner's capital account, and here you can see the opening balance. So C should be naturally getting, you can see the C's column. Okay, you can see this capital accounts column, debit side, credit side. Debit side, we have written all those items which will be reducing the partner's capital account. In the credit side, we have written all those items which will be increasing the capital balances. So we see the opening balance. So opening balance of C, it should go to C's capital. Usually we prepare all the partner's capital account at the end of the accounting period. So here also we prepare all the partners capital accounts in a columnar form. So A, B, C, all the three partners are there. C is the retiring partner. So all the three partners will be getting the opening balance. You can see it here by balance brought down. The amount is written in the amounts column. Then revaluation profit. I told you we have to prepare the revaluation account just like admission. There we will consider all the change of value of assets and reassess the liabilities, and we find out the difference. We will take it to the revaluation account. Then we may get profit, we may get loss. So if it is profit, it will be coming in the credit side. If it is loss, it will be coming in the debit side, right? So revaluation profit will be shared among all the partners in the old ratio. Okay, in retirement you can see all the partners will be getting all these balances, right? So opening balance is gone, revaluation profit is gone. Now if there is any profit and loss credit balance given, it will go in the credit side. Then if reserve fund is given in the question in the balance sheet, it will go. All this will be going in the old ratio, right? The figures will be divided based on the old ratio, right? Okay. Now the most important item, that is goodwill. Okay, so here the new partner is going, and this partnership business was result of his efforts also. So whatever was their profit, asset, whatever success was there, it was all due to the efforts of the combined efforts of all the partners. So C also should be getting an entitlement. Okay, C also should be getting a benefit. So C should be compensated for whatever things he has done for the business. Okay, so in order to compensate this C, another concept is that one is just to compensate to C because he is going, he has to be compensated. Second thing, when C is going, his share is taken by the remaining partners, who in this case A and B. So when A and B gains C's share, in the future only A and B will be sharing the profits. C won't be getting anything. So because of this, C has to be suitably compensated. Okay, so C should be getting a compensation in the form of goodwill. Again, we take the same concept of goodwill in admission. Okay, so in admission, we know that in the case of sacrificing partners, the older partner sacrifice naturally. So the new partner has to bring goodwill in order to compensate to the older partners. Here it is reversed. C is going, C is leaving. Okay, and remaining partners will be the gaining partners. So whoever is gaining has to compensate to the retiring partner. So if C's share is taken both by A and B, in this case you can see the gaining ratio we already discussed, because no other information is given here. So gaining ratio will be 5:3. So it is certain that A and B both are going to gain from C's retirement. So both A and B has to compensate the retiring partner, that is C. Okay, so for this purpose they will calculate goodwill. Okay, so in order to compensate the retiring partner only, they will calculate goodwill, and they will first calculate the total goodwill. Then out of the total goodwill, they will find out C's share, and this C's share will be again divided between the remaining partners. In this case A and B, it will be divided in gaining ratio, which is, you can see here, 5:3. Okay, right? And C will be getting his share from A and B in his capital account in the credit side. So of course C will be getting, so we have to write it in the credit side, and A and B both have to give it, so they will lose that much amount, so their capital will be reduced. So this double impact, it will be coming here. You can see A, it is coming here, for B, C, it is coming here. Understood? This is a type of contra entry, right? So C will be getting, so in the credit side, and A and B will be losing, so it will be deducted from their capital account, so in the debit side. And here you have to write C's capital account. Here C's capital account, which is a common entry, so we will write a C's capital account common entry and put the respective share in their capital account. And here from A how much is coming, it will be written in C's column. From B how much is coming, it is written in the again in the C's column, so that C will be getting the total goodwill, his share of goodwill, dear students. I hope you understood this particular what to say goodwill treatment. Now another important concept, if goodwill is already appearing in the books of accounts, if it is given in the balance sheet, right, that is existing goodwill. So what to do with existing goodwill? In the last class also I made it very clear, if there is existing goodwill, you simply write it off. So write off the goodwill among all the partners in old ratio. You can see this in the debit side of all the three partners. You can see this. I have given a star mark also. Why the star mark? Because it is the existing goodwill. Okay, it is existing goodwill. Goodwill is appearing in the books, so you simply write it off. Okay, right. And remember, this is not in gaining ratio. That is very important. It is in old ratio. So write off the existing goodwill among all the existing partners in old ratio. So do it here. It's done. And if there is any profit and loss account, debit balance, or rather the loss given in the balance sheet or in the question, you that also you show it in the debit side, again in the old ratio. Remember, dear students, for admission as well as for retirement. Okay, for admission, sacrificing ratio is used only for goodwill, and on retirement, this gaining ratio is used only for goodwill. So in short, we can say goodwill is closely related to sacrificing ratio and gaining ratio. Okay, now you can see, dear students, we have written all the items: opening balance, profit. These are all the retiring partners entitlements. We have shown almost all the items including goodwill. Okay, sometimes there can be some other fund also. For that also the adjustment is more or less same. We have discussed that in admission. So see all the credit side items, see all the debit side items. We write all these items. After that, you total the capital accounts, take the balance. First you total retiring partners capital account, both sides. Okay, and find out the balance, and that balance is the entitlement. That shows the total amount the retiring partner will get from the partnership business, that means from the remaining partners. Okay, so suppose we got total, let us say 50,000 rupees as the total balance, 50,000. Then how this amount should be paid? There will be clear instructions in the question. Okay, if there is no instruction in the question, you simply transfer this to C's loan account. Okay, you no need to pay it immediately. Suppose 50,000 is to be paid, so this 50,000 the partners can pay in installments, right? So immediately what you have to do, we have to transfer that amount. So this is the balance. See, this balance we transfer to the loan account. Okay, loan account of C's loan account, it will be transferred. You can write in the bracket transfer, right? Okay, then in some cases, on some questions, there will be instruction. Okay, you give the full amount, that means the total amount total amount of this C's entitlement, it has to be paid completely. If the partners have got sufficient money in the cash account, in the bank account, they can pay, no problem. So if they wish to pay, they pay. So when they pay, it will be written as cash account. In my example, suppose 50,000 is the total amount payable to C, and if this 50,000 is paid by both A and B, then it will be paid in this way, to cash account. You can write in the bracket settlement, right? Final settlement. Full amount is paid to C, and the amount is written here in C's column. So that in C's column there won't be any balance. There won't be anywhere C's column, there won't be any balance. If at all any balance is there, it will be transferred to loan account only. Okay, so that is why you can see when we write the balance carry down, there will be balance only in the remaining partners capital account, right? So payment of this final payment of this retiring partner, we have let us say three cases. One, full amount is transferred to loan account. One example or situation. Second situation, part payment. So how much is paid? You pay here by writing to cash account. The balance show in loan account. Third, full payment. You pay by writing to cash account, write the full amount here so that there won't be any balance here, there won't be any balance in the loan account also. It will be completely closed. So these are the three situations. Now, so I hope you understood this particular accounting treatment. Accounting treatment we follow when there is a retirement in the partner's capital accounts. And you can see it here. I have written the goodwill cases on retirement just to go through these two cases. When goodwill does not exist in the books, we adjust it through all the capitals. That is what we have discussed, that double entry, both sides, type of a counter entry. And if goodwill already exists in the books, I have told you, written off. So for goodwill, there are two cases mainly. There can be two cases or two situations. So deal it accordingly. Okay. Now, for the final payments to retiring partner, there can be three cases, which also I discussed just now. One is full amount paid, that is known as paid in lump sum. Then part payment, some amount is paid and the balance is transferred to loan account. Third one, full amount transferred to loan account, which will be paid in installments by the remaining partners with most of the cases with interest. Okay, so in this way partners close their accounts on retirement. Okay, and the loan account of retiring partner is not there in the syllabus right now, so no need to prepare the loan account. CBSE has deleted that topic. Plus balance sheet preparation is also not there, but I would tell you, I would advise you, you always prepare the balance sheet so that you get a clear picture of retirement. Just like you have done on admission, here also you prepare the what to say, balance sheet. Okay, I hope you understood today's class. Okay, in the next class we will discuss another topic. Okay, thank you very much.